Good morning, afternoon, or evening, ladies and gentlemen. Welcome back for another YouTube video. This is going to be your daily cryptocurrency market update on this fabulous Friday. And we're going to kick the video off by recapping on yesterday's market driving events, which of course was the US CPI, which came out pretty bad. The overall CPI year on year came out at 8.2. We know the prior one that we had was 8.3, so we saw a 0.1 reduction. But we actually saw, in terms of core month on month, an increase in inflation. This is very bad, and in my opinion, affirms the path that the Fed are on. And we've spoken about just how detrimental that path of interest rate hiking with persistently high inflation, you end up in this stagflationary environment, just how detrimental that is to markets and liquidity across the board, which we are going to be talking about. It's going to be a big day for the UK. Lots of news coming out on the UK. So the Dixie is going to be one to watch. Yesterday, we actually saw the Dixie slide off. This was because we're at technical levels. We are going to be doing a little bit of TR on Bitcoin. So this is going to be quite a long one, guys. We're even going to be looking at the UK bond market and then talking about a little bit of crypto news, because this is a crypto channel. From an investment point of view, we've been very focused on the sort of macro and economics generally and what that looks like, because it drives our market. But we are 100% starting from next month going to be making sure you guys get at least a couple of videos daily on crypto specific things, because I am still all in crypto. Yes, we're in stable coins right now, still cryptocurrencies technically. And actually, stable coins are extremely useful, because prior to that, I'd have had to go and exchange my money at a currency exchange, or I'd have had to set up an international bank account, which can be very costly to do and you get quite bad rates. Whereas now you can download a crypto app and get US dollar or euro exposure, whatever exposure it is you're trying to get. So we are going to start covering a lot more crypto content. Let's not waste any more time, guys. Let's kick this video right off. So inflation came out pretty stubborn yesterday, and the market reaction essentially confirms what the Fed are doing and the fact that they're going to have to continue to do so. Let's take a look at the euro dollars and let's take a look at the daily candle that we had yesterday. So the euro dollars, and this is something that we've looked at in comparison with Bitcoin. We've said that there's a huge correlation here. This was shown to us by David Bell. I didn't even know what the euro dollars was until he explained it. But there's a huge correlation here between the euro dollars going down, which means that interest rates for the US are getting priced up, and Bitcoin going down as a result of the sort of larger drain of liquidity that it has on it. So if we look at the euro dollars yesterday, this is pricing in and priced in higher interest rates, because we saw this huge candle down, and then there's actually quite a large shadow on this. Yesterday was a nightmare. From somebody who was trying to trade yesterday, you'd have been better off not. I think the only people that came away well yesterday were the people that just didn't even bother trading it, because it literally tanked and then completely retraced and actually put in a new high. There were definitely bidders, and we can look at Bitcoin when we do a little bit of TA. But the Eurodollars were showing us that essentially what this inflation number means was that interest rates are getting priced in more significantly. We can take a look at the Fed's 30-day futures. This was the lovely red candle that you had yesterday, and it's now starting to somewhat retrace. And I think there's a lot going on. You know, people are always trying to second guess markets, and markets aren't always forward looking. The price of today is really what people are expecting the price to be in the future. I think that because inflation is staying persistent, it kind of goes, oh, well, these interest rates aren't working. So what would be the point in continuing to do them? I think some people are kind of throwing that narrative about, and we know people are gasping for this pivot. Markets have essentially become crack addicts, in the sense that they are, you know, we've had liquidity, QE since 2008. And now that that liquidity has been taken away, we've seen the temper tantrum that they have thrown. But the reason this liquidity is getting taken away is because of inflation, because of how persistently high it is. So the key factor, and this is something we've been talking about for 6 months now, that we took from Jerome Powell, was we are going to bring, this is what he said, paraphrasing, demand in line with supply. So we're going to kill demand and bring it in line with supply, thus lowering prices and bringing inflation back under control. That hasn't ended yet, and it's actually set to get tighter. We've just shown you the euro dollars and the 30-day Fed funds futures. And this is because of, obviously, inflation being persistent. Inflation is actually extremely detrimental. I did on Sunday a huge, or not a huge thing, I do weekly meetings with my patrons every Sunday. And we looked at and really tried to just sort of get into inflation and show just how negative it actually is. Because, yeah, everyone's looking at interest rates and going, damn, it's pretty bad that they do that and it drains liquidity out of markets. But inflation does the exact same thing, maybe a little bit less on a corporate level. You can kind of say one's worse than the other, but they're both pretty darn bad, and we've got both of them present at the moment. And this is kind of tying into our thesis that we think until some of these issues subside, we definitely see lower prices across the board for risk generally, not just the crypto space, which is why we stay largely out of markets and sat in stablecoins and US dollar stablecoins at that. So this was interesting. Today's going to be another interesting day because we've got stock futures are lower ahead of Friday's big bank earnings. So today you've got some pretty significant banks. I see if I can find them here. I don't think they've got a list, but I can probably tell you them off the top of my head. You've got JP Morgan, Chase, you've got Mellon, and then you've got another big one. It might be BlackRock, all coming out with earnings today. So if those earnings are down, and what I think we are now being in a recession going to be sort of getting hit by is a wave of negative earnings. So we're going to see persistent, continuous earnings declining, just like growth GDP generally has been declining over the next, several. Well, it doesn't have to be several quarters, but certainly, next couple of quarters. And I think that this is going to sort of really hit home the fact that we are in a recession and that it is set to get worse. And in terms of price and what's driving it, we've looked at this time and time again, daily on this channel. We know that things are going to continue to see that downside. If what we've seen take place and be put in place so far has had this effect, there's more of that set to continue. This was interesting. Cross-border capital, somebody that's well worth following. He really drives home this sort of point of liquidity. Ignore the bond market at your peril. Decomposing US Treasuries into a two-part shows bad things. Rate expectations zooming and term premia crushed by tight liquidity. We must be near a crisis pivot. So in my opinion, what is going to cause the Fed to pivot is going to be a crisis breaking of... They have a choice right now between persistently high inflation that's going to completely devalue their currency and really reduce all kind of credibility that they have, which they don't have a lot of at the moment, or choosing to essentially... have systemic failure. Now, the systemic failure, even though it's showing up, hasn't happened, but I think it will, and I think that's what's going to have to make them revert and go, the system cannot just handle high interest rates. We need to revert back to this zero, if not minus interest rate, kind of free money and liquidity period, because that's kind of how the system has to work now. We're at a stage where the velocity of debt is just simply too huge to ever be paid back, and that because of the size of it, if you up interest rate, it has catastrophic and massively destructive and collapsing sort of bearing elements to upping interest rates because of the simple size of the debt just cannot be repaid. You kind of almost need to proliferate the money system just to repay. Well, you do. This is how the system works in order to repay the debt. And at this size, the debt is so big that you actually can't, just even incremental, even a 25 basis point interest rate hike, it, really dries up liquidity from certain areas, and they've been on a sort of interest rate rampage across the board, and we've seen markets react, and there's more of this set to continue. It's going to be an interesting day for the UK. UK cliff edge arrives as Bank of England prepared to end the emergency bond buying. This is not going to go well. This is where the Bank of England stepped in, and we're only just hovering. They're set to end this today. If that does happen and they don't do a U-turn from that, and we know that essentially the Kwasi Kwarteng, I'm not great with names, essentially has flown back early from the IMF meeting to obviously sort of see what's going on here, because if they end this, it's likely that you're going to see that continuation to the downside. The problem with the bond markets and the treasury markets going down is that they're kind of the bedrock of society, and their value going down means the value of pension funds and the value that pension funds have get completely destroyed, and so on and so forth, and it has real knock-on effects. So in my opinion, we really are at this kind of period where there's serious systemic risk taking place that is likely going to lead to what potentially the yield curve, the 10s and 2s, is predicting, which is a capitulation event, a crash, if you will. Doesn't have to happen, could be completely wrong, and there could be this sort of knight in shining armor that turns up, whether that be Russia-Ukraine ending and going back to normal or whatever it may be. But in my opinion, right now, there's a hell of a lot of risk on the table, not even factoring in the fact that interest rates are set to rise and continue to drain liquidity and boost the dollar. And also, as far as the US is concerned, crush other nations. And we also have persistently high inflation, which is also very negative and sort of kills the wealth of the masses. So I don't think it's a good time to be an investor in the markets. And I do see further continuation. And just because yesterday, this is essentially, let's take a look at yesterday's price action. We were trading this, guys. We were short, and then we had to get out and essentially say, look, we're not going to try and stand in the way of this move to the upside if it's going to be the case. But this was the price action that you had. Almost no point in trading. Don't get me wrong. If it just is one-sided, you can do very well, providing you're on the right side of sort of big economic data days. However, when you end up with days like this, both longs and shorts get wrecked. You get stops getting liquidated across the board. It propels it to one side or the other. But this was, of course, the market action. We got this high inflationary news, which was detrimental for markets. It reinforces what the Fed's doing and should be very negative. And instead, we saw this kind of U-turn. Then towards the end of the day, we had all sorts of narrative about, get ready for a massive, some insider information on the Bank of England. They were going to hugely pivot and this, that, and the other, which is going to be interesting to see if that does happen. If it doesn't, there's going to be some spitting feathers later on today. But this was your market action, and Bitcoin has actually climbed. In my opinion, ladies and gentlemen, I spoke with this and we were looking at this. The reason that this got bid was simply because it's attractive from a trading point of view. You don't short support. You're typically going to take the long at support rather than the short because you know where your stop is below that support. And it offers a better risk to reward than short in here. So bidders would have bid this up, and this is why you've seen this continuation. In my humble opinion, this is a matter of time before this rolls. This is not the bottom. I think you're going to get down to 13K. I think you're just building this up. I think once you actually start, not only to get back in here, because you got to respect support, guys. Look how much support there is here. Once you get below this and you convincingly break it, just like here, for example, if we look at where all your bids were, you got bid up at this area. You got bid up again. But the problem is that once you kind of, once those bids stop, and you can almost see, notice how this is kind of like, it's losing momentum. So if this is like, it's losing momentum. And then you maybe have one, and then you do something like that and spill. Can you see how it's losing momentum? It's almost in a more severe fashion than what these were. These were just kind of pauses, areas of consolidation, and then you got that spill to the downside. But can you see what I'm thinking this is going to be is this. So it's typical you have one kind of squeeze to the upside. Can you see how you had this squeeze over here? Before you then set in motion that continuation to the downside. Same thing happened here. I think you're going to play it in a similar fashion to this. It's very, very common on areas of consolidation. I mean, even on smaller areas of consolidation, that you have. Can you see this? You're consolidating. You're not really doing a lot. You get this kind of push up, and then you get the spill to the downside. That was a textbook support and resistance. You can see it all the time, guys, and I think this is essentially what's playing out here. I think this is the final stab to the upside before we get that continuation. I think what really happened yesterday was, they're trying to get people out of the markets, trying to wreck positions. They've sent it one way. This is basically, in my opinion, what I would call a bull trap that's going to lead to that continuation to the downside. Very, very surprised and it's not out of the realms of possibility. Look for your levels up here. And then your major support would be there. Don't think you're going to get much past this one, to be honest. I think if you do come up here, you're going to get huge bids and huge shorts coming in that could take you down. The problem is the longer you come and keep sort of knocking on this door, eventually it will open. So I still absolutely am adamant that there's more downside for the crypto space. We will be looking to position into shorts. We had to get out of a lot of our shorts yesterday and look for sort of a better entry. If you want to take part in that, you're welcome to come over and join me on my Patreon. But we are still very much looking for that downside and continuation. And yesterday was just a bit of a nightmare day. Not really changed anything in my opinion. In fact, it's almost reinforced everything that we have kind of been thinking that, conditions are going to get worse and we're going to see that further continuation. Also, you got to remember yesterday, what essentially happened was the dollar had a pretty significant pullback. Now, this was because inflation is high. So if inflation's high, that means that currency is devaluing in relation to goods and services, which shows a weakness in it. So this actually is bad for dollars, but is deemed almost good for. We're in this kind of backwards market where bad news is good news and good news is bad news. We're in this kind of weird market where what's essentially happening is, okay, inflation's high, that should be bad for the currency. However, the actions that the Fed are going to take as a result of this inflation is actually good for the currency because it bolsters it and causes more liquidity and more demand for the dollars because you need a higher interest rate to pay back the dollars. So today's going to be very interesting. Gold's down. The stock futures are actually marginally up today. Watch out for these big bank stock earnings. Not really a market I want to touch. It's Friday. It's low vol. I'd rather wait for some sort of a point to take this market back to the downside and look for that big sort of swing, hoping to capture from this long now period, 110, 15 days now we've been consolidating here. 122 days we've been consolidating here. The move you get to the downside from this is going to be significant, and I am hoping to capture a move somewhat like this or like this. You know, remember we caught both of these moves. You know, and catch that next leg to the downside. So that's really what we're setting up for. Watch the UK bond market because this just looks like a mess. A little bit of quick crypto news. Web3 devs more active than ever amid crypto winter. Remember, guys, that crypto is absolutely a technological revolution and isn't going to stop despite the price action. And the fundamentals really do not reflect the price. And the fundamentals for the crypto space continue to thrive, and not only thrive, continue to get adopted. We see all big players move their hands towards the crypto space, as this is the next asset class, ladies and gentlemen, and there's the opportunity of a lifetime setting up. Ethereum's price size 35% rally after 600 Ethereum burned in 1 week. Well, there's going to be more than 6,000 Ethereum sold this week, likely. So it kind of cancels that out. And remember, really, markets are driven by buy and sellers, not really hodlers. They have already affected the price. They do take supply off the table just in case there is that real demand surge and a lack of supply. However, in a market where, you know, people are readily willing to sell, you know, these kind of metrics don't come massively to in supply. All I've got for you in this video, guys, be careful today. We're likely going to sit this one out and see if we can look for those shorts to the downside. If you enjoy this content, like us, always appreciate it as a comment. I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, guys. See you in the next one.